Hey everyone, today we'll be doing a advanced forecasting discounted cash flow valuation example. This is for my financial management 2 class, which is corporate finance. So let's go over it. The first thing you want to do is read the assumptions. And what we'll see is that with the first assumption, it is all cash flows occur at fiscal year end. So the 2017 cash flows will occur in 1 year. The English is kind of bad, so if I struggle with it, it's because I didn't write the assumptions, so that's why I'm going to have trouble reading some of them. So what does that statement mean? It basically means that we're at the end of 2016. So when we're doing our calculations, we want to keep that in the back of our mind. WACC is 5.9786%. So what you want to be doing is writing down these constants. So these are, I usually write it down as assumptions. So what we'll do is we'll say WACC, and we'll put that in as 5.9786%. So we put in the WACC, and it's going to be constant throughout the years. I don't recommend pasting it for all the years, and I don't recommend doing this equals to the previous year thing because it'll mess you up in the future when you do your future calculations. It's easier to just keep the cell constant or fixed or locked and do your calculations that way. Sales growth rates are given in the spreadsheet, so we have that. Use 2020 growth rate as terminal growth rate. So that just means that in your free cash flow calculation, G equals 0.025. So we can actually do that now. We can put it somewhere here and set it equal to the change. And I'm just making sure I was recording. Okay, yeah, I am. The ratio G CAPEX over delta sales, or sorry, change in sales, is 0.46. So, well, I keep saying so, but there's a reason for it. In the assumption, it says equals to GX, but I actually wrote that down. You should have that memorized, that G CAPEX over change in sales is nothing but GX. And it's also given in the equations that are here. I actually put these equations down because you can easily get them. And it's easier if they're all there. But I did remove all the additional information that I had done to the question when I solved it multiple times. So that means that I'm doing it from scratch. The average depreciation will be constant at the 2016 value. So let's calculate depreciation then. So depreciation rate is constant, but we still need to calculate it. And you can look at the formulas and you'll see that it's depreciation expense divided by depreciation expense plus the previous year's, plus the current year's PP&E. You can see in the formulas that net stands for net PP&E. So then we do plus the net PP&E, and we get this number. It's actually a percentage. So we're good. And like I said before, you don't want to do this equal thing. Assume that the following accounts remain fixed throughout the forecast: amortization, goodwill, and intangible assets, other assets. I'm purposely going slow because what you want to do with these questions is you want to take your time. I'm not a person who usually takes my time because I'm kind of impatient, but I'm trying to show that if it really matters, you need to take your time. So that's why I'm taking my time with this. So amortization, goodwill, and intangibles. And you'll see that when I was pasting that, I'll show that again. When you paste something like this, you can do control, and you want to go over this thing over here, and it's called formulas and number formatting. So what that means is that you paste the formula while also inheriting the formatting of that cell. This prevents any formatting overrides. other assets, so other liabilities. You'll notice that other liabilities, there's something called other current liabilities. You want to make sure that you're not assuming anything that is not part of the assumption. It clearly says other liabilities, so you want to read that verbatim. Other liabilities and other current liabilities are two different things. Common stock and non-controlling interest. So common stock and non-controlling interest. So non-controlling interest and common stock. Okay, we're good. Long-term debt is the plug account. So it's best you start the assumption now. So long-term debt equals total assets minus total equity minus total liabilities excluding long-term debt. Excluding long-term, yeah. So where is the plug account? The plug account is total debt. I have actually bolded it, but it's not going to be bolded. So as my equation says, we do total assets minus total equity minus total liabilities excluding long-term debt. So what is this? It's nothing but total current liabilities minus other liabilities. You can't really do subtract total liabilities because total liabilities is nothing but the sum of including total debt. So you can't really do that. So you'll see that the equation is missing some values. So let's actually plug those in. Total assets, we'll start with this. And total assets is missing some values too. PP&E. So now we have to calculate PP&E. PP&E, if you look at the formula, is nothing but CAPEX plus the net of the previous year minus depreciation expense. And we haven't even done any CAPEX calculations. So now would be a good time to actually do CAPEX calculations. CAPEX is nothing but MCAPEX plus GCAPEX. So what you want to do is you want to plug that formula in for all. And MCAP, now we do MCAPEX. MCAPEX, if you look at the formula, is depreciation rate divided by 1 minus the depreciation rate times the PP&E of the previous year. So since it's the PP&E of the previous year, we don't have to worry about this circular imports or circular references, because by the time when this is calculating, this PP&E should have already been calculated. So now we do, and if you don't know what I mean by that, we'll get to it. So now we have to calculate GCAPEX. And since GX is given, we get GCAPEX equals change in sales times the GX. So GX, which I did not plug in, I don't know why I didn't plug it in, but you want to make sure that you're not doing something weird. So 0.46. So we do 0.46 times the change in sales. It's a change in sales, not a percentage change in sales. So you have to calculate that change in sales. So that is this times the previous sales. Now you'll see that the number is negative. It's a GCAPEX, and GCAPEX can never be negative because GCAPEX is basically the CAPEX needed to grow the company, to support the growth. So you want to change this formula so that it only works, it only calculates it if the sales growth is positive. Otherwise, the GCAPEX is guaranteed to be 0. So we do that formula, and I probably went by that really quickly, but it'd really help if you knew some Excel knowledge, so an if statement can really help you. The other way to go about this is you can check manually if the sales growth is negative, and then you can put 0. So you could probably do 0 here, and then you can just do the formula here like normal. But I think I forgot to lock something, so now we can redo this. You'll see that these are also not calculating properly, and that's because we did not finish it yet. That's only 1 year. So now that we got CAPEX, we can go back here. And what else does PP&E require? It requires, so it's CAPEX plus the previous year's PP&E minus the depreciation expense for the current year. So you'll see that the depreciation expense for the current year has not been calculated yet. So you know these formulas are right. So the depreciation for the current year has to be calculated, which is nothing but, we'll use our formula again. You can see that it requires the use of the depreciation rate. And since the depreciation rate is constant, we want to lock that in. We multiply it by the previous year's PP&E, and we add the CAPEX as stated in the formula. And you can see these values, some of these values just updated just like that. So this is formula for it all. And you want to double check again that the formula is using the correct depreciation rate, because that's really what happens with constants. You can easily mess them up. So you can see that everything's working fine here. Everything's working fine here. What else? Since we did that and our GCAPEX is still not correct, we can do revenue now. And revenue is pretty simple. It is this plus the sales growth. Okay? Now, I have no clue what that error message was. Now, what I will tell you is, I use that statement a lot too, but I'm doing the calculation a certain way. I'm doing it like a tree where you have to calculate where you're going through the assumptions and you fill in the assumptions, but if that assumption requires the calculation of something else, then you calculate that, and so on and so forth. But there are different ways to go about it and different orders to go about it. It's not really important that you do it a certain way. What's important is that you do everything, so you calculate everything that you need to calculate. You know which things need to be calculated using a formula, and you type in the formula correctly, because as you just saw, I had locked in the growth of 2017 rather than locking the row. So there's that. Now that GCAPEX is good, we know PP&E is good, we have to still calculate total assets, which is total current assets. And here we go, which is this, so we just copy that. And we see these numbers and now we're thinking, I guess that's as far as we can go. And yeah, so we go back to, there's two things you could do. You could either go back to the assumptions, or you could just go a level up and go back to total debt, what it requires. And it requires total current liability, so we just do the same thing here. And we see the same thing. We don't know how to calculate accounts payable yet because we didn't read the rest of the assumptions. So fill it in. What else do we need? We need total equity, so we go here. And Whistler is this, because if you look at the formula, it just this. Now we get retained earnings, and retained earnings is nothing but the retaining earnings of the previous year plus the net income of the current year. You want to make sure that your formula is correct. I had once selected income tax before. So we do that, but we're not done. We actually have to calculate net income now. Net income is this formula, which is income before tax minus income tax. And income before tax is a formula. I'm going to do that. But what is income tax? Income tax is the tax you pay on your income, which is a percentage. So let's fill in a new thing. We have to calculate the tax rate now. We do that, we get a tax rate of that number. And to calculate the taxes you pay, just do that and you fix it. Do this and you're good. Now, what else? Income before tax depends on EBIT and interest. So we'll do the easy one first, EBIT, which is this formula. It's given to us. Interest, on the other hand, needs to be calculated. So now we have to do this again. Interest rate. Now, interest rate is not given in the assumptions. And mind you that we still have not read all the assumptions. So what do we have? We have interest paid of the previous year. If you think about it, the interest you paid in the previous year depends on the debt of the previous year. So the interest expense divided by the debt of that year's previous year over here gives you an interest rate. And since we're using this to calculate the interest of the future years, it's going to be a constant value. So what we do now is we do this interest rate, we fix it in place, and we multiply it by the previous year's total debt. And we get a value, and we just copy and paste it. Now, it's kind of faltering, so we'll come back to that later. And this is probably because of, it depends on total debt here, which we forgot to do that. And you'll see this itself is faltering too. And that's because we're missing these values. So we will keep going up though. EBIT. Now EBIT depends on this. And at this point, or even before, you would have said, okay, let me just finish reading the assumptions. So if we finish reading the assumption now, no dividends are paid. So this thing would affect retained earnings if dividends were paid, so we're good. Percent of sales forecast should be based on 2016 ratio to sales. So now we know how to calculate these blank values, percentage of sales. But I don't actually like doing it that way because it requires a bit too much work. It's a bit easier if you think about it in a different way. These are percentage of revenue, according to percentage of sales. These numbers are percentage of sales. So if sales grows by a certain percentage or decreases by a certain percentage, so will these numbers. So we don't actually need to we don't have to rely on revenue or anything. We can actually just do operating expenses will increase or decrease by the same amount that sales increases or decreases by. So like before, we will lock in that row and we get this number. We get 1 plus 15%. So 1 plus negative 15% is that new ratio. So we don't have to do the division or anything that you might be used to doing. We can take a shortcut. And by taking the shortcut, our lives becomes a lot easier because we can just paste this one formula across the board, across everything that relies on percentage of sales. So that would be, what did I do? Yeah, so sales, goods, and administrative expenses is one of them. Cash, accounts receivable, inventory, other current assets. This is also percentage of sales. And I hope I'm not going too fast, but since it's all based on that one formula and that formula is very versatile, we can get away with pasting it across multiple cells. And we can do it again here with accounts payable, other current liabilities. And is that all? Let's see. total liabilities. So since we're basically done the balance sheet, we might as well finish it off. So total liabilities is pretty simple. You know, you probably don't even need to do that. And this is pretty simple as well. Don't need to do that. But then there's also this, shares outstanding. You can question yourself if it's relevant. It's probably not relevant. It's actually not relevant, but we can fill it in like that. And somehow, just like that, we have finished the balance sheet right as we finished the assumptions. We ended up leaving the easiest thing to do, which is the percentage of sales, as the finishing step. But just because we're done the income statement and the balance sheet doesn't mean we're done with the question. We still have to do the valuation part, which is the most difficult part to remember how to do. So we'll do it based on simple steps, which is simple concepts. So let's see here. We have these formulas, but they probably don't make any sense to you. So what we have to do is get to our price. The whole point of DCF is to get to the fair value price. So what you can do two things. You can work from bottom up, where you have to figure out price, and to figure out price, you need some other information. Or if you remember how to do stuff, you can go right from the beginning. So I'll take a different approach this time, which is to go bottom up. I believe it's the more difficult thing to do, but for that reason, we'll do it. So we'll do price. Now, what is price dependent on? Well, price is dependent on the number of shares. And what else? I'd say the value of equity. Now, how hard is that to remember? I'm not exactly sure, but essentially a company is its assets equals its liabilities. As we've done before, I didn't explain this formula, how to get the plug account formula, but it's basically based on the concept that assets equals liabilities plus owner's equity. And the same way here, a value of the firm is equal to its, if we look at the formula, value of the firm is equal to its, so the value of the firm minus the value of its debt divided by the number of shares equals the price of intrinsic. So V of firm minus V long debt is nothing but value of equity. And you can see that value of equity equals this. So we have value of equity, we have number of shares, we do this. So value of equity divided by number of shares, we get this. Number of shares is given to us. It is nothing but, it's right there. Oh, value of equity. What does value of equity need? Needs three things. The NPV, the redundant assets, and long-term debt. So long-term debt, redundant assets, and what else? NPV. NPV is going to be the hardest. Long-term debt is given to us. Let's do that. So we do value of equity equals this plus this minus this. Okay. We could also add something like that to get the redundant assets. So if you look at the assumptions again, you should have memorized it. You'll see that there's one called ignore redundant assets. So in this case, we got lucky, it's 0. But if we weren't allowed to ignore them, it would just be cash and investments. There's no investments, so we're good here. NPV. So now comes the difficult part. What do we do to calculate NPV? This is extremely difficult, but if we look here, we'll go back to our assumptions. It says that we have to calculate the forecast for the next 4 years, and then after that, we can assume that the growth will be, the terminal growth rate will be this number right here. So two components then, which is the present value of the perpetuity, so present value of the terminal value, which relies on the terminal value, And what else you need is the growth rate for that. And the other component of NPV is the present value for free cash flow. So sum of present value free cash flow 2017 to 2020. I hope I was a bit clear on how I got those numbers or got those components, but I'll go over it again. To get NPV, there are two parts to it. The manual forecast plus the perpetuity. So this part would be like the perpetuity. And it'd be based on 2021's numbers because the terminal value would be calculated for the end of 2020. And yeah, so these four could be, the growth is given for that. So, it could be any of these. And then from then on, it is just you just use a growth rate. It's pretty simple. So terminal value, or let's see, NPV. So NPV equals this plus sum of PV free cash flow. So now we have to calculate these, and it's a lot of headache. So now at this point, we've realized, okay, we have to do free cash flow. So we have to figure out how do we get free cash flow, and let's see how we get free cash flow. Free cash flow is OCF minus the increase in net working capital minus CAPEX. So you can see the remains of these things over here, but they're basically the years up here. And you can just copy this over. So again, we have to calculate free cash flow, and to calculate free cash flow, we need the OCF, the increase in net working capital, and we don't actually have the increase in net working capital anywhere. We have to calculate it. And how do we calculate it? Well, we have to get net working capital first. So then we get the increase in net working capital. And I suggest using new and not plus, or increase in net working capital, because if you use plus, it might interfere with your free cash flow calculations. Then we need CAPEX as well, which we've already calculated. Then we can calculate free cash flow, but we also need to get the sum of free cash flows. We need to calculate the present value of the free cash flow. So we need to discount it. So let's begin. 2016 can be ignored because, like we said before, we're at the end of 2016. So 2017. OCF equals DE plus A. So DE is depreciation expense. It used to be D in the formula, but that would have definitely confused someone. And someone would have thought that it means debt, but it means depreciation expense. Made it clear over here. So we get depreciation expense plus the amortization plus the EBIT times 1 minus the tax rate. And since the tax rate is constant, we need to fix that. And we need to make sure we need to make sure that nothing else needs to be fixed, and we're good. So depreciation expense plus amortization plus EBIT times 1 minus the tax rate. All good? All good. Copy this over and format it with a comma. Net working capital. Net working capital is a bit complicated. You don't want to rush through this. And it is current assets minus cash minus current liabilities minus short-term debt. There's no short-term debt in this question, so we're good. I've expanded the formula or the equation so that it's a bit easier to actually do. And if you expand it, you do some double negatives and you get this. So we get current assets. You really have to make sure you are picking the right cell, it's really easy to misclick. Minus the cash. Minus the current liabilities, which is total current liabilities, plus the short-term debt, which is 0 in this case, so we're good with that. Copy that over. No, it works. New network capital. So this is not a verbatim statement, okay? This is, there we go, that's what I meant to say. Increase in network capital. Now, to calculate the increase in network capital in 2017, we actually need the 2016 value. So we'll calculate network capital of 2016 for that. So we get the increase in network capital is the network capital of the current year minus the network capital of the previous year. Don't think too deep about it, because if you start thinking too deep, the negative values will confuse you. So you'll see negative 29,000 over here and negative 35,000, and then you'll see 5,000 and you'll start to think, how did we get 5,000? That doesn't make any sense. But if you think about it from the increase is nothing but the current minus the previous, then everything makes sense and you don't overthink about anything. So CAPEX is just from before, calculated before, and there we go. And now the fun part, which is free cash flow, or is it really the fun part? Who knows? So we get OCF minus the increase and minus the CAPEX. Again, don't overthink this subtraction part with the new network capital. It's very easy to look at this equation and start overthinking, and then you completely mess up the concepts. We did a subtraction here, and we do another subtraction. And yeah, you don't want to overthink it. You're subtracting the increase in network capital, not anything, nothing else. Okay, now we have present value of the free cash flow. So I've moved it down because the present value of the free cash flow is not an easy it's not a simple calculation. You have to discount each free cash flow by a certain number of years, depending on the WACC as well, incorporating the WACC. So what you actually have to do is you want the WACC here, and you also want the year. And what you can do actually is you can do this, and you can do this like that. And yeah, that formula actually worked. I was experimenting and was surprised that it worked. So WACC is actually given. Again, with these questions, you need to make sure that you're capable of having at least somewhat of a good short-term memory. And your memory should remember the most important things, the most important assumptions. I'm not I'm not going to be remembering something like goodwill and intangibles. I'm not going to remember that number. It's pretty easy to fetch. But what you should remember is, where can I find that number? Or where can I find the things I need to do? So now we do present value of the free cash flow. So we do free cash flow. Let me fix this first. So present value of free cash flow equals free cash flow divided by 1 plus the WACC, divided by the number of years that has elapsed. So we have locked in that year 2016 so that we can have an easy time copy pasting the formula. But like I said before, you always want to confirm that your formulas have been copied correctly, because as you can see here, we have copied the WACC wrong. And that's because I forgot to lock in the WACC. So now we do this, and we can see that everything is working according to plan. If you don't trust this year thing, you could also do this. You could do this, and something is. And you can manually confirm that the number is correct by using the raw 4. So we're good. So now we have calculated the sum of the present value of the cash flows. Or, sorry, we've calculated all those present value cash flow, so now we can just sum it easily. And growth, like I said before, is given to you. And the terminal value. So the terminal value requires the free cash flow of the terminal year. And we times that by the growth. We want to calculate the next year's free cash flow because we're currently at the end of 2020. And to calculate the sum of the future perpetuity cash flows, we need to use 2021's free cash flow. And then we discount it by the WACC minus the growth. Now we still need to do the present value of the terminal value. So the terminal value is, so this is the terminal value at the end of 2020. So the present value is this divided by 1 plus the WACC, the power of 2020 minus 2016, which is 4. The NPV is that. Redundant assets is 0. Everything works out, and we get 32.81. And that is the correct answer because I'm pretty sure I've done it here. So yeah, that is me doing the advanced forecasting discounted cash flow valuation from scratch. Hope you found it helpful, and yeah.